Welcome back to the channel. In today's video, we're going to look at whether mortgage rates could actually start coming down over the next few weeks. There have been some recent developments globally that may have a real impact on this, particularly news coming out of the Middle East. At the time I'm recording this, the situation around the Strait of Hormuz appears to have stabilized somewhat. Both Iran and the United States have indicated that it remains open, which has helped ease concerns in the oil market. As a result, oil prices have dropped quite sharply over the past few days. That's an encouraging sign because falling oil prices can help reduce inflationary pressure. Now, I'll break down what this could mean for mortgage rates specifically and what actions you might want to take if you're currently looking for a deal. While central banks like the Bank of England or the Federal Reserve do play a role, what really matters to you is the rate you're personally offered on your mortgage. That's what we'll focus on. Before we dive deeper, if you're new here, make sure to subscribe and turn on notifications so you don't miss future updates. This channel shares regular insights on property prices, interest rates, and investment strategies. Also, if you find this video helpful, give it a like. It really helps the channel grow and reach more people. Now back to the topic. Although things in the Middle East are far from fully stable, there are some signs of progress. That said, key global players involved remain unpredictable, so nothing is guaranteed. Still, the fact that the Strait of Hormuz is currently open means oil supply is less restricted, which is why prices have fallen. Even if tensions ease completely, it's important to understand that fuel prices won't drop overnight. It can take months for lower oil prices to filter through to consumers. However, what this does suggest is that energy costs are less likely to rise further from here, which is a positive shift. This matters because inflation in the UK was expected to be around 2% by now. The recent conflict disrupted that trajectory over the past 6 weeks. With oil prices now easing, it reduces the likelihood of further inflation spikes. As a result, markets may begin to rule out additional interest rate hikes from central banks. Just a few weeks ago, expectations were very different. Markets were pricing in multiple rate increases, which caused something called the SONIA swap rate to rise sharply. This rate is crucial because it's what lenders use to determine mortgage pricing. It reflects where they expect central bank rates to go in the future. When those expectations shifted upwards, lenders had to respond quickly by increasing mortgage rates. That's why we saw rates jump by over 1% in a short period, especially on 2-year fixed deals. These increases were passed on almost immediately, which slowed down activity in the market. Right now, many people are holding off. Remortgage activity has dropped, and brokers are seeing fewer inquiries. Buyers are pausing, waiting to see where things go next. Of course, some individuals who secured lower rates earlier, around 3.5% before the recent surge, are still moving ahead with purchases. But overall, demand from new buyers has cooled. Now, with oil prices falling and the geopolitical situation slightly improving, we could see a shift in expectations again. Instead of forecasting rate increases, markets may begin to assume that central bank rates will remain steady for the rest of the year, around 3.75% in the UK. If that happens, swap rates should start to decline. In fact, we've already seen early signs of that this week, with a drop of around 0.25%. Some lenders, including Santander and TSB, have already responded by reducing their mortgage rates slightly. That's a positive step for borrowers. If this trend continues, if oil prices stay lower, the Strait of Hormuz remains open, and inflation expectations ease, then mortgage rates could gradually come down over the coming weeks. There's another factor to consider as well. Lender competition. Because fewer people are applying for mortgages right now, banks are seeing a drop in business. They still need to meet financial targets, so they may start offering more competitive rates simply to attract customers. We've already seen this begin, and it could continue regardless of broader economic improvements. So there are essentially two forces that could push rates down. First, falling swap rates due to improved economic outlooks. Second, lenders lowering rates to generate more business in a quieter market. If you're in the middle of arranging a mortgage or expecting to remortgage soon, the best approach is to act early. Speak to a broker and secure a deal now. Most lenders allow you to switch to a better rate later if the market improves, so you're not locked into a higher rate if things drop. At the same time, if conditions worsen again, for example, if geopolitical tensions escalate, rates could quickly rise once more. That's why getting prepared now is a smart move. So what's your view? Do you think mortgage rates will start coming down again in the near future? That recent 1% increase in such a short time was significant, especially considering central banks didn't actually raise rates during that period. Share your thoughts in the comments. Don't forget to like the video and subscribe to the channel, and check out the rest of the content here as well.